Welcome to RBC's Markets in Motion podcast, recorded December 3rd, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, the early edition of our 2025 S&P 500 sector outlook. The big things you need to know with a focus on the sectors where we've made changes. First, we've upgraded communication services from market weight to overweight. Second, we're downgrading healthcare to market weight from overweight. And third, we're downgrading materials from overweight to market weight. If you'd like to hear more, here's another 5 minutes. Takeaway number one. We're upgrading S&P 500 communication services to overweight from market weight, which we see as our fresh idea for 2025. The sector has been an inline performer with the broader market since the election. Sectors that we like, frankly, have been tough to identify, and it's fair to say with this one that the absence of negatives is a positive. We also like what we're seeing in our earnings and valuation work for the broader sector and its major industries. On earnings, the sector has been strong relative to others in terms of the rate of upward estimate revisions for both EPS and sales, and the sensitivity of the sector's EPS estimate revisions to a stronger U.S. dollar is low relative to most other sectors. On valuation, the median PE of the sector is well below average relative to the broader market, and only slightly above average in absolute terms. Generally, the sector is one whose median PE within the S&P appears to be moving up off trough levels on both an absolute and relative basis. Meanwhile, flows to the telecom sector as tracked by EPFR, the closest comparison for this sector that we have recently turned positive as well, something we're also seeing for other growth sectors, including tech. Comm services also tends to outperform when consumer sentiment is rising, making it a potential beneficiary of better vibes in the new year. RBC's U.S. equity analysts did have a modestly bullish tilt on their sector outlook for the sector in a Republican sweep in our pre-election survey work, though to a lesser degree than what we saw for financials and energy. The key risk that we see to our call is that the sector tends to underperform when 10-year yields are rising. Moving on to takeaway number two. We are lowering S&P 500 healthcare to market weight from overweight. This was a tough call. Healthcare has been the worst S&P 500 sector performer since the election, though trends have stabilized in recent trading. We've liked this sector and are generally inclined to look for opportunities amid dislocation, but we just have too many questions about the sector's future policy backdrop and think it's prudent to move to the sidelines. EPS and sales revision trends for the sector do remain positive and stronger than what we see in most other sectors. But the sector also tends to be one of the most sensitive ones in the S&P 500 to a stronger U.S. dollar from an EPS revisions perspective. On valuation, median PEs for the sector are at historical lows relative to the broad market, making the case against an underweight. But they're only around average relative to the S&P 500 when we look at a historical absolute PE. This argues more downside may remain. Meanwhile, flows to global healthcare funds are negative and showing a deteriorating trend. The sector also tends to underperform when 10-year yields are rising, and RBC's rate strategy team currently expects 10-year yields to move higher through year-end 2025. Looking back to past elections, the S&P 500 healthcare sector did underperform in the 12-month period after both the 2016 and 2020 contests. One risk to our view, like other defensives, healthcare did outperform during the 2018 China trade war. And we'll wrap up with takeaway number three. We are lowering S&P 500 materials to market weight from overweight. Materials was the worst S&P 500 sector performer during the China trade war of 2018, and our U.S. analysts had a slightly negative tilt on the implications for their industry outlook under a Republican sweep in our pre-election survey. Meanwhile, earnings and sales revisions for materials have been negative, and the sector tends to be one of the most sensitive to downward revisions when the U.S. dollar strengthens. On valuation, the median PE of the S&P 500 sector is a bit below average relative to the broader market, making an argument against being underweight this area. But the median PE for the sector is elevated on an absolute basis, adding to our desire to downgrade. Two risks to our downgrade here, which support keeping this sector at market weight, not underweight as well. The improving flows to global materials funds is the first. These have also turned slightly positive. And the second is its tendency to outperform when ISM manufacturing is on the rise, suggesting materials could benefit if soft data continues to show improvement. Before we sign off, a quick rundown on our other sector views heading into the new year. We do remain overweight financials and energy. We remain underweight consumer staples and REITs. And we remain market weight industrials, tech, utilities, and consumer discretionary. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.